Hello and welcome to Investing Confidential. To get an understanding of really what's going on in the market today, you really got to take a little bit longer view back. And if you could, as you can see here on this chart, the market's really gone nowhere for almost 2 years. And it's probably going to continue like this for quite some time. It's going to be very choppy, as you can see. We've had this bear market rally, which started back in October of 2022, and it's been grinding higher. It doesn't feel like that, but it's been grinding higher. And we've broke out of a downtrend pretty much. But I really think when you look at bear markets and bear market, this is how it is, and we could be in a cycle like this for a number of years. I mean, when I say a number of years, I mean 5 years. I mean 7 years of this type of grind, where you think you're going to break out, and then boom, you go lower, then you go up, and you go lower, and you go up, and you go lower. So I just don't see any break in it, because the data, okay, the economic data and earnings data just continues to be a bad environment. Okay, so again, I continue to show these charts because more data comes out every day, every week, and continues to just re-emphasize what we've been saying all along. So let's look at some data right now, and here we go. Let's begin. As you can see here, first we have leading indicators. Okay, this is something that everyone should look at, and it's plain and clear. We're tumbling lower. These type of movements lower in the leading indicators, and this, as you can see, goes very far back, is a predictor of recessions. Okay, every time we get to this type of level, and I think we're going significantly lower here in this type of level, is we're going to we're going to be in some type of recession. So speaking about recessions, again, here we look at this. Here we have Fed probably. This is New York Fed probability of a recession, 12 months ahead. I mean, again, longer term, we're at the same level of the late 70s, early 80s, when this country was in a deep recession for a long period of time. We're way past the great financial crisis. We're way past the pandemic. And again, this is New York Fed probability of recession. As I told you, my view is we've been in recession for quite some time because the numbers are completely misleading. But just based on the pure numbers, the treasury spreads, et cetera, it's done. I mean, there's no way to get around it. It is done. Okay, so here's some other data. Let's look now at Philly Fed. Okay, again, these are all Federal Reserve type data. Look at the Philly Fed manufacturing index. Absolutely destroyed, plummeting. Again, we're back down to the great financial crisis levels. Okay, here's CapEx. Okay, CapEx important? Well, this is what if companies don't invest, there's no growth. Okay, as you can see, great financial crisis companies stopped, and we're in a similar type situation. I think this is worse than the great financial crisis, but look, it's a similar type situation. Okay, now let's look at some more indicators. Let's look at what the consensus of GDP growth is going to be. Here we go. Okay, this is Bloomberg estimates. I mean, for 2024, is this Yellen said we got a strong economy. Is this a strong economy? Okay, I mean, again, you listen to the White House, you listen to the talking heads. Things used to be, you listen to people like that. You can't listen to them anymore. You can't listen to them. It's a complete joke what's going on. Okay, here we go again. Let's look at GDP growth again versus consensus estimates on a quarter by quarter basis. Okay, 2023, there we go, recession, predicting a recession in the third and fourth quarter. It's a done deal. I think we're going to see a recession in the second quarter. Okay, the first quarter they're predicting a little less than 2%. I think that's ridiculous. I don't think it's going to be that high. But even the people who are bullish are pretty much guaranteed we're going into a recession. Okay, almost a guarantee. And you look at what this could be, and I guess look at some positive things here because of this recession. Okay, you could see the potential for the CPI to come lower. I don't believe these numbers. I think CPI is going to stay around the 5%, 6% range. But if the economy falls off a cliff, yeah, we're going to have a pivot for sure, and we're going to have inflation coming around to the 4% level. It's not going to get to 2%, where our friend Mr. Biden thinks it's going to be. But, it is what it is. Okay. So, with all this, something here again, we've shown about small companies, private companies driving everything. As you can see here, bankruptcies among small private companies skyrocketing. Okay, this is shorter term data, but you'd have to go back to the financial crisis to see this type of bankruptcy data coming out of the U.S. It's very, very shocking, and it's very disturbing. And why do we see this? Well, quite frankly, it's the consumer. Okay, so here we go, looking at consumer data confirming a recession, Consumer Conference Board expectations. I mean, again, guaranteed the consumer has fallen off a cliff, predicting a recession. Okay, there's no doubt there's going to be a recession. It's 100% guaranteed now. Okay, and here, and this is why consumer confidence plunging. Okay, and what confirms that data? Let's look at some real interesting data. Okay, here's Taiwan. Okay, Taiwan top display. Again, remember, Taiwan manufactures everything we use in technology: computers, cell phones, everything. Okay, these are displays, and these displays are used in everything, in Teslas, and that now they're putting them on refrigerators. They've cut production. They're dramatically cutting production. Okay, there's no demand around the world. Okay, and here we go. Taiwan export orders slumped most in 2009. There's no demand for chips. Remember when they told you we have chip shortages for a long period of time? Well, we have a lot of chips now. You know what to do with them. They're puking them out. Okay, what are chips used for? Everything. Everything. Literally everything. So what does that tell you about demand from consumers? And then finally here, finishing up the consumer, I mean, credit card delinquencies are skyrocketing. Okay, and this is going to get much worse because unfortunately, where they're seeing the most is the younger people, the 20-year-old, the millennials, the Gen Z. They're defaulting. They're delinquent and defaulting on credit cards like ever before. This is the future of our country. Okay, how are they going to ever buy houses? They're not going to be able to because their FICO scores are going to be in the 600s. The 600s. These people, they don't understand these kids. I don't know whether the parents are telling them, but when you're 20 and 30, you cannot be defaulting on credit cards. They're living on the cards, and now they're defaulting on the cards. And so it is what it is. So let's talk about how this is really going to affect the stock market. And we're just seeing the beginnings. Okay, here we have predictions of margins. Okay, remember, margins are the key to earnings. And this data goes back 30 years. Profit margins have been up and down, but essentially rising for quite some time. Again, this is the beginning. I'm telling you now. I am warning you that this is just the beginning of a significant drop in profit margins, which will mean a significant drop in earnings, which will mean the stock market is going down to nowhere. Okay, that's the result of this type of action. Talking about stock market specifically, we look at the components of what makes the stock market move. Going back many years, dividends. People like the dividends. If you look at people who, for example, things like Philip Morris and other stocks like this, these companies generated amazing amounts of wealth. This is what the Warren Buffetts of the world, they like to see these dividends. And why? Because it's compound. You get the compounding effect. But look what's happened over the last 20 years. Dividends have meant less and less, and it's been all about capital appreciation. Okay, and with the demise of the earnings, you're going to see this diminish. And again, dividends feel more important. So if you're looking for it to hide, even with rates the way they are, you might want to look at dividend paying, higher paying dividend stocks as a way to go on a defense. And again, this is defensive, and you need to be defensive right now. I'm going to finish off with a couple of pretty shocking charts here. The last one being the most shocking, but here we have appliances. Again, we're talking about the consumer, and then real estate, and obviously real estate being one of the big edges of growth for the U.S. Look at this. This is interest in buying major appliances, which really drives the economy. No, it's trending significantly lower. Okay. Some good news on housing. It's not going to last, but you had a big move up in supply. That's good news for the industry itself, but bad news for prices. Okay. It's inevitable that prices are going to drop. And here we see the result, or what's really happening. Existing home sales in the negative territory. Okay. Negative territory. We have to go back over a decade to see this. Okay, not even during the drop of COVID did we see real estate drop in negative territory. Now we look at medium home price sales, negative. Okay, negative. So the realtors will tell you that the real estate's in good shape because there's no supply. No, the real estate market is about to collapse. Okay, the reason that there's prices haven't dropped even more is that everyone's waiting. No one wants to sell. They're afraid because there's no bids. But as I told you, these institutions like BlackRock, they are selling in the market. They're going to puke. Okay, Open Door Technologies, they're going to puke. And when they do, you're going to see a big drop in prices. And the other big thing on real estate in general is the impending, I guess, disaster of the commercial real estate, and obviously driven by office space vacancies, and then what we talk about, the cap rate. Now, this is dramatic, folks. This is dramatic. So cap rates, remember, as an investor in real estate, you want to buy high cap rates and sell low cap rates. Look how low the cap rates got in 2020, 2022, 2023. I mean, you can't make a return with those kind of cap rates. So cap rates now have exploded. That means there's no bids. If you want to sell an office building or commercial building, there's basically no bids. Okay. And so you're probably most likely going to default. Who takes the hit on that? It's the banks, mainly regional banks. This is why that's why this route is will continue. Now, I told you, I'm not worried about the banking system. The government's backstopping it. You're not going to lose any money in a bank. But if you're a bank investor, you're going to get destroyed. Okay, absolutely destroyed. And this is why cap rates exploding. Okay, and finally, the most disturbing chart that I've seen going back many years. Okay, here we are. Now, let me do it again. I've talked about this before. This is the 1-year CDS for the US. The way it works is this is like a hedge. As CDSs go higher, it's negative because you're betting that there could be some type of credit event, bankruptcy, whatever. Okay, going back to 2008, you could see the US CDS was relatively stable, almost nothing. Okay, the ultimate value, let's say in the US, is 1,000. So basically, it's now at 140 because there is this impending debt situation and the debt limit discussion within Congress, and we know we have a broken political system here. But I haven't seen this, and this is so negative. Okay, so negative for the U.S. dollar, so negative for the U.S. dollar, so negative for interest rates overall. And this is why the Japanese are getting out. This is why the Chinese have been selling out of treasuries for quite some time, and it's going to accelerate. Okay, and if you're a U.S. dollar investor, you must own gold or even Bitcoin. I think not crypto, but Bitcoin could also be an alternative. But I'm an old-fashioned guy. I'm a gold guy. Been around for 3,000 years. Okay, fine. You can laugh at me, whatever you want. But you need to have non-dollar exposure in your investment portfolio because of things like this. And it may come in when they finalize some kind of debt ceiling, but the amount of money we're printing, because this is also a relation of printing money. Okay. This is a problem. So I've never seen this before. Everyone should be concerned with a chart like this. So if you're an investor, you better be careful out there.